What up, guys? I wanted to make this quick hitter just because the iShares 20 plus bond ETF, or the TLT, it has been flashing some or showing some bearish signs that kind of confirmed the bearish sentiment in my last video on bonds and my reasoning as to why bond yields would continue to rise as prices continue to fall. And I'm quickly going to break that down in this video. So let's get right into it. So I think it's important to understand that we're all on the same page and make sure we understand exactly what the iShares 20 plus bond ETF is. And essentially, it tracks the long end of the curve in terms of the bond market. And so it's a long duration bond equity instrument, hence the 20 plus. I think this guy on CNBC actually gave the best description of what it is.
The TLT is a bond product wrapped in equity-like volatility.
Now, this is important because there's like 600 bond ETFs, and the TLT has the second or third most inflows of any of the bond ETFs. So we're talking about a lot of money here, guys. Now, two of the charts that I'm going to use here came from, or I borrowed from, Jim Bianco, which, you know, he's great. If you've never seen him before, watched him, you should. He covers the bond market a ton. He's fantastic. So yeah, appreciate you, Jim, for providing these charts. So this first chart is going to show the short interest. So the actual short interest, it's on the bottom there in the orange, and the price of TLT is at the top. And so looking at this chart, obviously, you know, there's a sentiment shift in terms of how investors feel the bond market is going to perform. And according to this, there was kind of a big expectation in bond prices of long-term treasuries coming down. And so that's why you're seeing that massive short interest. Now, this second chart, you see at the bottom the cumulative inflows, and at the top, once again, you have the TLT price. And you can see with the massive record inflows since 2022 that it hasn't helped the price at all. The price has still fallen precipitously over time. When I say precipitously over time, I mean since its March all-time high of 2020, it's fallen 49%. And it only has a yield of almost 4%, 3.8%. So, I mean, there is no win in the TLT at this point right now. Bond investors have been getting murdered over the past 12 months. TLT investors. Well, bond investors in general too. Now, I've been seeing the narrative of a soft landing pick up steam once again. But if yields stay elevated and they continue to move higher, that just adds more competition for the stock market. So although we had that overreaction to the latest CPI report, I think things will eventually balance themselves out. I don't think we're going to have a soft landing. I don't know how deep of a recession we would have, and maybe we already had a rolling recession. But either way, I know it's not a soft landing. Remember in my last video, I mentioned how the Fed has still over $4 trillion in bonds that they have to offload from their balance sheet. And adding more supply in the face of the weakening demand that we've already seen, that only puts upward pressure on yields. And obviously, I'm not the only person thinking this, when you can see it with the short interest on the TLT, which tracks long duration bonds. And so you got to ask yourself, you know, why did the Fed pause in the first place? Well, they don't have to continue QT or tightening monetary policy just by raising interest rates.
Obviously, we're monitoring, we're attentive to the increase in longer-term yields, and which have contributed to a tightening of broader financial conditions since the summer.
They also know that demand isn't as strong as it should be for treasuries. So them offloading bonds from their balance sheet is a form of quantitative tightening as it adds more supply to the market. And so both of those mechanisms essentially accomplishes the same goal.
The most important thing is that these higher treasury yields are showing through to higher borrowing costs for households and businesses, and those higher costs are going to weigh on economic activity to the extent this tightening persists. And, you know, the mind's eye goes to the 8%, near 8% mortgage rate, which could have, you know, pretty significant effect on housing.
Anyway, guys, I said this was going to be a quick hitter. I hope this has provided you with some value. If so, like, leave a comment. Definitely subscribe, tell your friends, and I'll see you on the next one.